Hi, my name is Sunil Sharma. I'm the Chief Investment Strategist at Ambit JPC. And let's get started with the monthly investment summary. This month, we talk about risk on and risk off assets. So, from a risk off perspective, gold and silver are doing extremely well and beating most other asset classes. The reason for the performance of gold and silver is largely because of the worries around the US dollar, the weak performance by the US dollar year to date, as well as rising worries about the US debt, which is now 37 trillion. And there's a 2 trillion shortfall between revenue collections and expenditures. And so clearly investors are choosing to diversify into other markets and other asset classes. Coming back to equities, most equities in this list are doing extremely well. And the reason for that is looking at the NASDAQ, the S&P 500, Europe, emerging markets, China. The reason for that is twofold. One is rate cuts, and it's not just the US, which expects 3 rate cuts by the end of the year, but also 85% of global central banks are in rate cut mode. So significant expectations of growth. And the second thing is the emerging optimism and rising CapEx budgets on AI, as well as evidence of early wins that are starting to come through on AI. That's driving these markets higher. One of the things that we think it's extremely important for investors to recognize is the divergence between US economy and the US equity markets. This is a chart of the Dow transports, and it's been largely flattish since June 2022. And we consider that a proxy for the physical US economy. And in contrast, if you look at the Max 7 and you look at the NASDAQ and the S&P 500, they're working in a world of their own. And I think that is something that we talk about in more detail and share more information in the commentary. Another distinction that we get into is the increasing comparisons between the Max 7 today, or tech, large cap tech today, and the bubble, the NASDAQ bubble of the late 1990s. And while we share a lot more data in the commentary, I'll share 2 charts here. One is showing the earnings growth of the tech index in the late 1990s, from 1995 to 2000. That was 77.5%. In comparison, the index grew by 476%. So essentially 400% higher move in the index than was driven by earnings. And that's why that became a bubble. There's just a lack of earnings delivery. In contrast, looking at the Max 7 earnings today, as this chart shows, the index is moving largely in line with earnings growth. And we look at both the trailing and the 4P EPS. This is clearly a very different environment from the environment that we witnessed in the late 90s. There's a lot more in the piece on US and global markets, but we'll move forward to India. And for India, one of the key themes we've heard of late, particularly in the media and also in some conversations, is the lackluster performance of the Indian market. And we wanted to take a look at a second level or a deeper look at that. And so we used a methodology called the relative strength ranking, and it's a methodology used very commonly in the US. And we share that data for large caps here and also for mid caps or small caps in the commentary. And our findings were twofold. Number one is there are many stocks, 25 out of 100 large cap stocks have delivered returns far in excess of the index, beating the index by almost 16% year on year. And and then that holds for mid caps as well as small caps. And so clearly, what we're finding is that the returns in the Indian markets are fairly diverse, dispersed this year and this cycle. And stock selection, industry and sector and theme, and is going to be very important in determining portfolio returns, as well as one can argue the cap weightage as well. Now, the second reason we did this and the second finding or observation out of this is that there are usually industries that emerge out of market bottoms. We still believe the March bottom was a cyclical bottom, and the recovery has been doing well, but has been sidetracked by concerns around the tariff and the worsening global and geopolitical situation. But that as that resolves, and also because of FI selling, as those resolve, Indian markets will start their move higher because the fundamentals remain in place. And our second observation was that a number of industries are actually the leadership industries, and we find that across large, mid, and small. We urge you to take a look at this highly interesting data, and we get into more detail on what industries are the ones that are leading this rally in the commentary. Now, coming to the flip side, which is a different way to understand why the index has underperformed, or one need look no further than the performance of the IT stocks and also the FMCG stocks as well as energy. And in particular, the IT stocks have delivered significant negative returns. We've been negative on a large cap IT since 2020, the summer of 2020. The fundamental case for us was in place, and that has turned out to be largely the right call on many of these names. And as a result of the negative contributions, the Nifty is being held back. And so, as we said in our earlier slide, stock selection is going to be extremely important going forward. So there's a lot more on equities and our investment outlook on Indian equities as well as global asset classes. But for this presentation, we will close out with precious metals. And again, lots of information and charts on the precious metal move. We have been long gold, or we titled a piece when we went overweight gold in April of 2024. We've been overweight gold for largely the most of this rally that has been taking place in gold, and we were tactically overweight silver also in late April 2024. And so, we share a lot of information on where we think the gold and silver precious metals rally is headed. One of the charts we'll share here that's interesting is that rate cut cycles by the Fed have typically been environments where gold has done extremely well, and as a corollary, silver as well. And the other point we would make is that so far we haven't really seen U.S. institutions or U.S. retail really get involved in gold and silver. And so there's been various markers that we'll be looking to take off as we move forward in this cycle on gold and silver. We will note, however, that Indian investors are now starting to jump into gold and silver, and we share some of these charts in the commentary. And so to wrap up, this is our asset allocation, and we remain overweight equities. We think the fundamentals remain in place, and lots more in the commentary on that, as well as our positioning on various asset classes. Thanks for joining us. I look forward to seeing you guys next month. Thank you.